Something is very wrong with America's largest home builder. D.R. Horton, the company that builds 1 in every 10 homes in this country, is spending up to $40,000 per home out of their own profits just to buy down mortgage rates and get buyers to close. On some homes, they're stacking another $75,000 in incentives on top of that. That is desperation pricing, and it's happening right now across Texas, Florida, and the Carolinas before what could be the most important earnings report in the housing market this year. On April 21st, D.R. Horton will release their second quarter numbers. Wall Street has already been quietly slashing expectations. The stock has been sliding while the rest of the market moves higher. But here's what the headlines are missing. The incentive packages D.R. Horton is offering right now are more aggressive than anything they offered during the worst months of the 2008 housing collapse. Let that sink in for a second. We haven't even gotten the earnings report yet, and they're already more desperate than 2008. Now, whether you own a home, you're trying to buy one, or you're thinking about selling, what happens on April 21st could directly impact your next move. And I'm going to break that down for each of you before this video is over. But first, there's one data point that just came out last week that almost nobody is talking about, and it tells us exactly where this market is heading. I'll get to that in a minute because understanding the full picture is critical before I show you that number. Let's start with what we already know. D.R. Horton reported their first quarter earnings back in January, and on the surface, it looked okay. They beat estimates. Revenue came in at $6.89 billion. Earnings per share hit $2.03 versus the $1.93 Wall Street expected. But here's what that headline number hides. Net income dropped 30% year over year. They closed 6.5% fewer homes. The average selling price fell 3% to $365,500. And their gross margin, the thing that tells you how much money they're actually making on each house, came in at 20.4%. But management admitted that number included a one-time warranty recovery that artificially inflated it by about 40 basis points. The real margin was closer to 20%. And then came the guidance that spooked Wall Street. For Q2, D.R. Horton told investors to expect margins between 19 and 19.5%. That's a meaningful drop, and it's being driven entirely by one thing: incentives. CEO Paul Romanowski said it plainly on the earnings call. He said new home demand remains impacted by affordability constraints and cautious consumer sentiment, and that incentives would remain elevated throughout fiscal 2026. His COO Michael Murray confirmed that incentive spending has been climbing throughout the quarter and was now in the low double digits as a percentage of sale price. Think about what that means. On a $365,000 home, low double-digit incentives means D.R. Horton is spending somewhere between $36,000 and $45,000 per home just to get buyers to sign. And in some markets, it's even more than that. Quick favor before I take you market by market. If this kind of data is already making you rethink your next move, hit subscribe and tap that notification bell. We drop new housing market intel every single week, and the people who see it first have a real advantage. The algorithm is not your friend. The bell is. All right, let me show you what's happening on the ground. In Texas, which is D.R. Horton's home state and their biggest market, they're running what might be the most aggressive promotion in the history of American home building. Late last year, they launched a 0.99% introductory mortgage rate. Not a typo, 0.99% in the first year through a 3-2-1 temporary buydown layered on top of a permanent buydown to 3.99%. When the prevailing market rate is 6.3%, that means D.R. Horton is eating the difference out of their own margin. In Dallas-Fort Worth, they're offering $9,000 or more in closing cost assistance on top of the rate buydowns and design upgrades. Active listings in Dallas have surged roughly 40% year over year to about 30,000 homes. The median days on market jumped to 75 days. The sale-to-list ratio has dropped to 93%, meaning sellers are getting 7% less than what they're asking. And about 28% of listings are already carrying price reductions. Austin is even more concerning. Redfin data shows there are now 112% more sellers than buyers in the Austin metro, the widest gap of any major city in the country. Days on market have hit 91 days, the highest since 2011, and the median sale price has fallen 3.6% to $412,000. Houston is softer but still showing cracks. prices are flat, days on market climbed to 74, and total sales declined 3.3%. Now, let's move on to Florida because the same pattern is playing out there, and in some ways, it's even worse. In Tampa, home values have dropped 4.2% year over year, according to Zillow, and over half of all active listings, 53.8%, have price reductions. A local broker described the market as, I quote, molasses. Orlando has posted one of the steepest city-level price declines in the country at negative 8.4% year over year. Days on market have stretched to 76 to 78 days, the longest since 2016. Jacksonville now has nearly 61% of listings with price cuts, and pending sales dropped 24% in the latest comparison period. And then there's Phoenix. 65.9% of listings with price reductions, the highest of any major Sunbelt metro. Newly listed single-family homes are selling for 12.6% less than a year ago, and pending sales dropped 33%. Even the Carolinas are getting hit. Charlotte's Mecklenburg County saw days on market surge by 30 days in a single year. Raleigh's inventory jumped 25% year over year, more than double the national average. What's important to understand here is that this isn't random. These are the exact markets where D.R. Horton does the bulk of their business. When I tell you their margins are getting squeezed, this is why. Every one of these markets is telling the same story. Inventory is building, buyers are pulling back, and builders are being forced to pay more and more just to move homes. Now, let me show you that data point I mentioned earlier, the one almost nobody is paying attention to. On March 19th, the Census Bureau released their January new home sales data, and buried in that report was this number: 128,000 completed but unsold new homes sitting on the market. That is the highest level since June 2009, the absolute peak of the last housing crisis aftermath. Total new home inventory has ballooned to 476,000 units, which at the current sales pace translates to 9.7 months of supply. For reference, a balanced market is about 6 months. We're 60% above that. And here's the part that makes it even more alarming. The median new home sale price dropped to $400,500 in January, down 6.8% year over year, but that price only reflects what's on the contract. It doesn't account for the tens of thousands of dollars in buy-downs and incentives builders are layering on top. The effective price decline for buyers is significantly larger than what the official data shows. Now, remember, I said earlier that D.R. Horton's current incentive levels are more aggressive than 2008. Here's the context for that claim. According to the NAHB, 67% of all builders were offering incentives in December 2025, the highest rate in 5 years. 41% were cutting prices with an average reduction of 6%. During the 2008 crisis, 86% of builders offered incentives and 48 to 59% cut prices. So we're not at 2008 levels yet on a national basis, but in the Sunbelt specifically, in D.R. Horton's core markets, the numbers are converging fast. And D.R. Horton individually, with their 0.99% rate promotions and $40,000 plus incentive stacks, has already crossed that threshold. If you're still here, you know more about what's actually happening in this housing market than 99% of people scrolling past clickbait headlines. So do me a solid, hit that like button. It takes 2 seconds and it costs you nothing, and there might be a foot rub in it for you. Not from me, but from somebody else. And it tells YouTube to show this to more people who need to hear it before April 21st. All right, back to the data. And no, there's not going to be a foot rub in it for you. And D.R. Horton isn't the only one bleeding. Lennar, America's second largest builder, just reported a 53% earnings decline. Their gross margin collapsed to 15.2%, down 350 basis points from a year ago. They're spending 14.1% of home sales revenue on incentives, roughly $52,000 per home. KB Home reported a 65% earnings drop. Gross margin fell to 15.3%. Their average selling price dropped 10% year over year because, unlike other builders who use buy-downs, KB Home has been doing straight price cuts. Even the NAHB Builder Confidence Index has now been below the break-even level of 50 for more than 23 consecutive months. The buyer traffic subindex is at 25, a number that tells you foot traffic at model homes has essentially collapsed. The only bright spot in the entire industry is Toll Brothers, which caters to luxury buyers and just posted a 25% earnings increase with margins holding at 25.5%. That tells you something important. The stress is concentrated in the entry-level and first-time buyer segment, which is exactly where D.R. Horton lives. So here's what all of this means for you, depending on which seat you're sitting in. If you're a homeowner right now and you're not planning to sell, don't panic. The structural housing shortage in this country, estimated at 3 to 7 million units, hasn't gone away. That provides a floor under values over the long term. But if you bought in a Sunbelt market in 2021 or 22 at the peak, you need to be honest with yourself about where your equity actually stands today. Check the comps in your neighborhood. Look at what new builds are selling for nearby, because those heavily incentivized sales are becoming the new comparables that appraisers use. If you're a buyer, this might actually be one of the most favorable environments for you in the last 5 years, but only if you play it right. Builders are desperate to move inventory. Those 0.99% rate promotions, that $40,000 in buy-downs, the closing cost assistance, all of that is real money coming off the price of your home. But here's the catch. Wait for the April 21st earnings report. If D.R. Horton's numbers come in worse than expected, incentives are likely going to get even more aggressive. Patience is leverage right now. If you're a seller, especially in Texas, Florida, Arizona, or the Carolinas, you need to understand that you're not just competing against other resale listings anymore. You're competing against builders who are willing to give away $50,000 to $75,000 in incentives to sell a brand new home. That changes the math completely. If you're priced at what your neighbor sold for 18 months ago, you're likely overpriced. The market has moved, and the longer you wait to acknowledge it, the further it moves without you. Now, here's the bigger picture and why April 21st matters so much. Mortgage rates just spiked back to 6.38%, up from 6.05% in February. That February number was the lowest rate we'd seen since August 2022, and it briefly sparked some optimism. That optimism is gone now. Higher rates mean more affordability pressure, which means builders need even bigger incentives, which means more margin compression. D.R. Horton guided for 19 to 19.5% margins in Q2. If rates stay elevated through the spring selling season, even that lower guidance might be optimistic. And if they miss, if that margin comes in below 19%, you're going to see the entire homebuilder sector reprice overnight. The stock has already fallen roughly 17% in March alone, from $164 in mid-February down to about $134 today. That's a 26% decline from the September high. Multiple analysts have downgraded the stock. Wells Fargo went to equal weight in January. Barclays set a $129 price target that's below where the stock trades today. But remember, a bad earnings report isn't just a stock market story. It's a signal about what's happening in communities across this country. When America's largest home builder tells you they can't sell homes without giving away their entire profit margin, that's information every homeowner, every buyer, and every seller needs to hear. So keep your eyes on April 21st. That's the date that could confirm whether we've officially entered phase 2 of this housing downturn or whether the spring selling season provides a lifeline. We want to hear from you. Drop a comment below with what you're seeing in your local market. Are builders offering massive incentives in your area? Have you noticed price reductions? Your observations help shape the content on this channel, and we read every single comment. If you found this valuable, hit that notification bell because next week we're breaking down exactly which zip codes are showing the earliest signs of major price corrections and which markets are actually still holding up. The viewers who catch these videos first get the best shot at positioning ahead of the crowd. The bell makes sure you don't miss it. Remember, this isn't about fear. It's about being informed and positioned ahead of what's coming. We'll see you in the next video. I'm going to get a foot rub.